Standard with myself, Dineo Tsamela. It's good to be back. And I'm joined today, as always, by Simon Brown. I just want to make sure that before we kick off, that everyone can hear me. So if you can hear me, could you please lift your digital hand? It would be the hand icon next to your name. All right, perfect. Simon, good morning. Welcome to the Market Standard after the US elections.
Thanks, Dino. And 37 sleeps until I'm on holiday again.
Yeah, lots of counting down to holidays at this time of the year. I think winding down, but it's been obviously a very interesting year because apart from just being exhausted from general year things, it's been almost a year of all of us being indoors, really. So an unusual one, and of course, US elections and Brexit that still has not quite happened, and actually we have no idea what's happening there. So an eventful year.
Yeah, 2020 was always going to be a big year. We just didn't quite understand why it was going to be big, and I think it came to us from we didn't see the pandemic, so it was big, but for reasons we hadn't quite anticipated.
True, true. I suppose kicking off today, we're going to start with what everyone's thinking and talking about, which would be the US elections. And we're already seeing the impact, stronger rand, really doing well. The market is green today. I think at some point, during the elections, and it took quite a while to get through because there were record voting numbers. So quite a few records smashed, really, to draw or bring Joe Biden over the line.
Yeah, it was. And I mean, Danero, we'll talk about the rand when we touch on local, but from our top 40 perspective, last week was the fifth best week of all time in our market. The Offshore index up some 8% for the week. Rand, as you said, a whole lot stronger. We'll touch on where that could go and implications for that. But I mean, the counting's still ongoing in some states. It looks like Arizona and Georgia will go to Biden. That gives him 306. So he's in 20 January. He will be sworn in. At this point, he's running at about 4 million votes ahead of Trump in the popular vote. And interestingly, both Biden, Biden's got the most votes ever in a presidential election. Trump gets the second most votes ever. But certainly, the votes are in Biden wins. The interesting component is then the Senate. And there was issues around, would the Democrats get the Senate to go with Congress and therefore really give them the ability to sort of rule almost a carte blanche? And the short answer is probably not. North Carolina looks like it's going to go Republican, and then ditto with Alaska. Alaska always goes Republican. And then two special elections out of Georgia. So it'll be 50-48. The 48 for the Democrats includes two independents. And then January will be the runoff election. If the Democrats can get to 50-50, the deciding vote is Vice President Harris, of course, so that'll split. But it looks like they're going to, the Republicans will just sneak ahead in terms of getting the Senate. So Democrats will have Congress, or the House and the President, and then the Senate will be Republicans. And the question then is, from a market perspective, what's the implication? And the first point is that I was going back and digging around and looking at different presidential terms and the like, and my sense is that big picture presidents probably actually have less direct influence on the market than I think a lot of people think. And we often say that the economy is not the market and the market is not the economy. And I think that Senate, it's going to be a lot more around foreign policy where Biden gets a lot more carte blanche in terms of executive orders and the like. Now, of course, big trade deals and stuff need to be signed off by Congress. But, for example, the tariffs that have been imposed on China, I think we'll see some rolling back of that, but probably just more a level of consistency, whereas it felt like the last 4 years it's all been run via Twitter. But, I don't think the Democratic Party and Joe Biden looks at China and considers them to be a completely innocent bystander. Obviously, they'll roll back into the Paris Climate Agreement. I think they'll relook at Iran. Iran has implications because that could bring a lot of oil back into the market, and then of course environmental issues back in the US, which could remove some oil from the market. The other big one obviously is going to be stimulus. Will there be a stimulus passed between now and the 20th of January? If not, will there be one passed early in the Biden administration? And the trick there is, again, back to the Senate. They don't have the Senate. So will we see much stimulus coming through? I don't think we're going to get that $2 trillion dollar package, but we probably are going to get a fairly chunky one. And we're probably going to get it. My sense is we'll probably certainly that it'll start happening now. And if Trump is reticent, then it'll be signed sort of early after inauguration on 20th of January. And then, of course, the other one is just the pandemic in of itself. Joe Biden is likely to respond to it differently. And a lot of that response could be more mask wearing, perhaps levels of lockdown. We're not going to see the sort of hard lockdown of April. What we've seen, for example, Wales just come out of a 17-day, what they call a circuit breaker lockdown, a lot less hard. We see the UK this week going into a 4-week lockdown, and again, not at the levels that were from back in April. And that's across Europe. But it will potentially sort of that K-shaped recovery we've spoken about before, where we have at the top of the leg has been the big tech and everything, and at the bottom of the leg has sort of been the sort of the base economy, airlines, restaurants, and the like. I think they're going to struggle a bit, continue to eke out, but not sort of boom at any sense in any time soon. Big tech is going to be interesting. A lot of sense that it was the Trump administration who was really looking at antitrust. They've filed a suit against Google, looking at breaking up big tech and the like. I don't think that the Biden administration is going to wholly back off from that. I think they might come from a different direction. And I remember during the Democratic primary, there was certainly talk around breaking up big tech, although that was more Elizabeth Warren and to a lesser degree Bernie Sanders. Of course, neither of them made it into the White House. But I do think that big tech is going to be sort of under the spotlight to a degree. And I went and read the entire 450 pages of report from out of the Congress on the antitrust. And they make some really, really good points. It's just a lot of them are really difficult to manage. For example, one of them is predatory acquisitions. In other words, you see a company that might potentially be a competitor, so you quickly buy them out to prevent them from being a competitor. Now, we certainly on the big level have seen that with Facebook buying Instagram and WhatsApp, and the others have done it at much smaller degrees. I don't know how you practically police that. I mean, I suppose you have to get the Department of Justice to sign off on tech acquisitions. That already is in many cases a requirement. So I think, my sense of the next 4 years under the Biden administration is things will change, but they're going to change sort of softly around the edges. The key change, which is what I think markets will like, is perhaps some consistency, less sort of ruling by Twitter and the like. And markets like a level of predictability. And I think more than anything, that will be the change for a Biden presidency. Quick last touch on emerging markets. We're seeing that a lot of money flowing into emerging markets, ours included, but across the world. And that's very much a risk-on trade again, where investors are saying, you know what, the US will look after itself. Let's go find some juicy yields. And those juicy yields are probably going to be coming from emerging markets.
Yeah. And Simon, I think the one thing which you did touch on in terms of rolling back some or a portion of Trump policies, I think without control of the Senate, as you pointed out, it will be very difficult to sort of pinpoint which rollbacks are likely to succeed. And how much of a fight the Dems are going to. I think within the context of a bit more stability, that that unequal ruling of different parts of the government really going to put a spanner in the works in terms of what actually gets done, what gets passed, and what doesn't, and that goes for the stimulus checks, etc. So I think from that perspective, it'll be very interesting to see if we have almost like an Obama-like administration where we really want to push certain policies, but there's just no getting through past the Senate. So going to be very interesting, certainly. And I think investors need to still, perhaps in the first year of the Biden presidency, really keep an eye out on what exactly the Republican Senate will be pushing back on.
Yeah, and that's going to be interesting. You mentioned, because I mean, Obama didn't have control of the Senate for much of his term, and interestingly, both the Iran deal and the climate change agreement both passed via a Republican Senate. And truthfully, the Democrats now have an extra couple of seats in that Senate. The point is who are those Republican senators, and how much might they fight back? And truthfully, we don't know yet. Time will tell. But have they gone perhaps more hardline or not? Or is it broadly going to be the same? But it is going to be a gentle walk. And I like your point. It's going to take a while. There'll be all the excitement around the first 100 days, but it's going to take much of 2021 before we really get a sense of how it's working. And also by then we're expecting, certainly in North America and Western Europe, COVID-19 vaccines to, by the end of next year, to have been largely rolled out. So pandemic more or less sort of behind the developed economies.
Yeah, definitely. Moving on now to US unemployment numbers, because despite the hurrah, we still are in the middle of a pandemic, and looking slightly better, but still concerning, I suppose, the fact that, and we've pointed it out several times, that, bouncing back will not be quite as quick as we expect it to be, but it is obviously taking a lot longer, and with the stimulus checks sort of in ballot, not quite knowing what's going to happen with that, one has to wonder, what are people going to turn to when the jobless rate is still not where it needs to be in order to, have sufficient spending, et cetera, to ensure that the economy still grows.
Yeah, I agree with you 100%. I mean, look, I will say off the bat, a 6.9% unemployment back in April. I've been on Twitter joking with some peeps that if it goes below 5%, I get his house or he gets my house. I forget which way around. But, even just a 6.9, if you had called that for October back in April, I wouldn't have bet 5 cents on it. I did not see that coming. Now, part of it is structural. It's like our second quarter unemployment didn't worsen because if you stopped looking for work, now that we certainly are seeing, there are still, and again, that's the sort of the bottom leg of that K-shaped recovery. If you've been working in the airline industry, if you've been working in face-to-face services, if you've been working at Disney World and the like, you're not looking, you're discouraged, so you're not considered to be unemployed. But all of those aside, a 6.9 for 6 months into a pandemic is a solid number, and they were earlier in the year at 3.5, so it's still sort of doubled from where it was. But I think it is a number which most economists will certainly take. The trend has been going. I really thought it was going to start getting difficult around the sort of 8% to sort of continue that trend through. We commented a lot around initial jobless claims were stuck at the 1 million and they couldn't break through that level. They've managed to come through. The jobless claims are looking markedly better. The economy is picking up. But there are the two key issues. One is, we've mentioned pandemic going into winter. The second wave in much of the world is way bigger than the first wave. If you look at France, the second wave is sort of 4 or 5 times the size in terms of cases. In terms of fatalities, not, because of course we've got better with the therapeutics. We're 8 months smarter than we were back in the hard lockdown days. The US economy is doing all right. I would still, the lack of a stimulus package still bothers me a bit.
Sorry, Simon. I think we lost you for a couple of seconds there. So
there we go.
Didn't catch what you said.
Sorry, I was just saying, I think the stimulus package is still going to be important. Going into winter, we're going to see a lot more COVID activity. And I do think that it is going to be an economy. At some point, it's going to start sort of leveling off. And I expected it sooner than this, but certainly it's done incredibly well. And the question is, how's it going to continue? How bad is the impact of the sort of second wave of COVID cases going to have impact? What will Joe Biden do under his presidency in terms of restrictions around COVID? But at this point, the American economy is doing a lot better than I think most people would have expected back in April. It still had a heck of a year. It's still in recession. It's still sitting 6.9% unemployment. But I think certainly probably stronger. And if we look at quick 25-year chart, we can see how slowly that recovery was from the great financial crisis of 08-09, whereas the recovery here has been markedly swifter.
Yeah, thanks, Simon. Moving on to China now, or looking at Jack Ma's big IPO, which was the Ant IPO, and that was supposed to be really the kind of stuff that was going to revolutionize, I suppose, banking to a degree in China. And that was a 37 billion IPO, US dollars.
Mm-hmm.
But, Jack Ma and Chinese regulators had a bit of a run-in, and because of that, I guess the IPO was suspended. And to Jack Ma and I think the Chinese market, but also an interesting look at how China can really flex its sort of muscle when it comes to these kind of things.
Yeah, I agreed. And I mean, Jack Ma had been reported of saying some fairly derogatory things around the banking system in China, around sort of the antiquatedness of it. And allegedly that's why suddenly new regulations arrived and they had to pull it. But the theory is it'll come back, but it is very much a case of the Chinese government, as you say, flexing their muscle, showing who's boss. But Ant Group is an amazing company. So they were looking to raise, as you said, around $36 billion, come to market with a valuation of about $300 billion. And pretty much everyone I've spoken to says their valuations are between $500 and $800 billion. And they do, it's not just Alipay, which was spun out of Alibaba, and Alipay is, I suppose, the equivalent would be MasterPass or SnapScan. And in China, obviously, the competitor is sitting within the Tencent app, WeChat. But it was, for example, the largest money market mutual fund in China is owned by Ant Group. Their personal loan book to individual consumers is bigger than any of the banks in America. It is absolutely a giant fintech business, and there are dozens and dozens of legs and revenue streams. I've touched on a couple of the bigger ones, but there's lots of other smaller ones out there. It's going to be a fascinating IPO when it comes back. My sense is it probably will, but maybe Jack Ma will be a little more careful. And I think the Chinese government will let it go ahead but also what it does is we look at Tencent and we think around sort of the WeChat, we think about the gaming, we kind of
Simon, we just lost you again.
So let me see if I can switch internet channels. Okay, let's see if that gets me better. What Ant Group being listed does is give us some insight into valuations on Tencent. Because Tencent, we look at their gaming business, we look at WeChat, QQ, but they've got a large fintech division as well, which I think a lot of investors don't really get sight and valuation onto. And I think we'll get Ant Group gives us a comparison in a sense. So I think it would have boosted Tencent as well. As I said, I think it'll come back, not sure when, but it's going to be an amazing IPO and a company that certainly I want to dig a lot more into once it's up and listed. But I think it's probably going to take maybe late next year before it returns.
Yeah, I don't imagine that the Chinese government will be, very easy on Jack Ma, and he certainly will have to watch his words going forward.
Yeah. They put him in his place now. I think
Moving now,
he will behave.
let's hope so. And now looking at the Bank of England, no interest rate changes, but they've really sort of put a lot back into their quantitative easing program. And, the economists all feel very differently about what we call it, and what its purpose is and whether it works or not. But I think, given the fact that they are going to be going into another lockdown, even if not as strict as the one earlier this year, it still will have quite a big impact on the economic growth and economic recovery. So very much needed funds, but I suppose the question is always, are we going to live to regret this a couple of years or months down the line?
So, I mean, that is the eternal question. And you know what? If we go back to 2008 and all of that quantitative easing, I mean, we haven't had the inflation come through yet. So maybe we can print money. I mean, I'm reading a great book called The Deficit Myth that basically says print away. But you're right, no change to interest, so stays at 0.1. The Bank of England has been talking to their banks and lenders around a negative interest rate, but obviously they're prepping the ground. They haven't yet gone there. And increased QE by £150 billion from 745 to 895. It's about a 20% increase. To put that into perspective, the UK economy is probably about the sixth the size of the US economy. And so this is probably actually sort of on track to maybe a little bit bigger from what we've seen so far in terms of stimulus out of the US. But it does, and you're 100% spot on, as they go back into lockdown, as the second wave comes through, even at lower fatality rates, but higher caseloads. Certainly, they needed to be able to, and they were fortunate, they're a G7 economy, they've got the balance sheet to be able to do it, to prop up the economy. And I still think, and I know, fertilities are down in the second wave because of better use of therapeutics and the like, but I still think that stimulus is needed for large swaths of industry and for economic activity. And the Bank of England, 150 billion is a giant, significant number. Now, of course, the Federal Reserve has been doing similar, but they're putting money into the market rather than a direct stimulus out of Congress, which would put money into individuals' hands, and that's fundamentally different. And what the BOE is doing here is, again, this is more going into the market, but we have seen Boris Johnson and his cabinet saying that they want to also start getting more money into, or continue the program of getting money into individuals' hands as they go back into that month-long lockdown, which I think started today, this week.
Yeah, Simon, and I think in terms of the approach where it's the balance is putting money into individuals' hands or business hands, I think that is going to be a very interesting sort of approach and seeing the end result. Again, it is going to be a waiting game, and I think this pandemic, if anything, has proven to us that we won't know what we don't know until a whole lot of time has passed, and we can finally see the impact of all the decisions being made in retrospect.
Yeah.
But I think it'll be interesting to sort of weigh up the different approaches across the country, especially different countries, especially when it comes to supporting the economy and what solutions they employed in order to try and save the economy as much as possible. So again, going to be interesting to look at France, Germany, a whole lot of European countries and how they fare against the likes of, the US and even Asia, I think, because different countries have been handling the pandemic very differently, and it's been interesting to sort of see the countries that are used to, wearing masks and things like that, faring a lot better, and
That's a
being able to continue pick up
Yeah, Dana, that's a
from
great
where they
point you
left.
make. Yeah, because we've seen it today. I mean, China's largely got it under control. They're actually going to get positive GDP growth for the 2020 calendar year. Some of the Vietnams, obviously South Korea, Japan to a lesser degree. And I wonder if let's say that the developed world is going to be 6 to 12 months away from sort of getting everyone vaccinated. I wonder if it doesn't sort of have a slight sort of impetus to those Asian economies and helps them perhaps gain a bit of ground on the sort of Western Europe and North American. It'll be a year or three before we can start to see some evidence. But as their economic activity gets sort of back to normal quicker than the Frances, the Germanys, the North Americas, if they don't perhaps get a bit of a benefit. Of course, their problem is that their market is often Western Europe and North America, and that those markets are struggling. But I think it's something which will be worth having a good, it'll be a fun PhD in 2 or 3 years' time.
Yep, definitely. And now, lastly, in terms of offshore activity or offshore news, Berkshire Hathaway record $9 billion stock buyback, and that was in Q3, quite a massive number. And I suppose the big thing is getting a better understanding of A, why do companies have share buybacks,
Yeah.
and B, why would Berkshire, is this like a strategy, sort of like as part of a let's wait and see what's going to happen? Because right now it might not be the best time to be going on a shopping spree, or what are the reasons behind this share buyback?
Yeah, so we'll touch on the reasons, and then we'll talk a little more generally about buybacks. So Berkshire Hathaway, Warren Buffett, Charlie Munger have always said, you know what, at about 10% above intrinsic value of Berkshire stock, we are buyers. And they have been, but typically that doesn't happen very often. Typically the stock is trading closer to 30, sometimes even 50% above the intrinsic value. So they're in the market, but the market is way above them, and they never actually get any opportunity to do any repurchasing. And now they come along and sort of the market kind of came to them and offered them that opportunity. So they were sort of buying on that leg going up. And I'm imagining that much of that was probably happening at the beginning of the leg. In other words, sort of early July, at down around the 170, 180 levels on the Berkshire Hathaway stock. And time will tell whether they're right or wrong. What I do like about their buyback program is that they have a fairly simple and transparent line in the sand. 10% above intrinsic value, they want to buy shares. And they've got the money. They've got north of 100 billion cash, so they can certainly afford to. Whereas oftentimes, the buybacks from management seem to be a bit haphazard. I know Long for Life were doing it recently, and their argument was quite simple, that just the book value of the business was X, and they were able to, in the market, buy back at about 20 or 30% below that value, and therefore they saw that as a really good way to deploy capital, and fair shout to them. But we've also seen some buybacks that you scratch your head and you're not quite sure why it was done at those prices and levels. So, time will tell. If next year things go really horrid, then it might not look so great for Berkshire. But their view is they've got their intrinsic value and they buy according to that. And in essence, buyback is when the company literally goes into the market, buys those shares, and then owns them, and then will ultimately cancel the shares. So what it means is that if I've held on to my share, what it means is that there's less shares for the same company, so my share gets a little bit more sort of valuable. And if you've got a pizza, instead of slicing it 8 ways, you slice it 6 ways, which means everyone got a slightly bigger piece of pizza. Yeah. And the key thing is that it's liked because it helps. There's no tax implication. Whereas if a dividend is paid back, if Berkshire had paid that dividend to shareholders, obviously there's dividend tax in the US. There's dividend tax the world over. So typically, I often look at buybacks a little bit squint. But I think if you've got a strong balance sheet and you've got a good, transparent process, which is Berkshire ticks both of those boxes, then I think it's well positioned to do.
Yep. Thanks, Simon. And I think, in terms of that, and I quite like that pizza analogy. I think very important for investors to just get a better sense of when these things happen, the why.
Yeah.
And that's why we had to just clarify, why do the companies do this? Because you want to make sure that you're fully informed before you make any investment decisions. So thank you very much for that. Turning our attention now to what's happening locally, and we touched on this at the start, looking at Rand strength post Biden win. And, we're all very happy because it's pretty much gone from like almost 1650 and yeah, almost down by a Rand.
Yeah, I mean, it literally was. It touched 1650 just over a week ago, touched 1550 early this morning. And it was 1950 back in the worst of the pandemic. So we have seen significant strengthening from it. And that, we spoke earlier up front around the election and investors moving into sort of risk-on trade, emerging markets. And certainly that is, the Rand plays into that. And then the question is, how strong for how long? And I'm, the Rand is one of those beasts. I mean, where we are essentially back to is the levels when Nklanhlanene got fired back in December 2015. We can see that collapse there, and we're back at those sort of levels. So there's still been, it's been a 5-year sort of sideways trade. But as always with the Rand, it's never just sideways. It is deeply, deeply volatile. I think there are a couple of drivers here that might give some more strength in the short term. When I speak, and let me preface it by saying, when I speak to the FX experts, they're all less convinced. They think we might get maybe even as low as 15, but they think probably more, ultimately, next year they're looking mid-year about 1620, at the end of next year 1650, which is a ways away, but for our volatile Rand, only a buck in a year is not too bad. There are a couple of drivers. The first is, and we mention this often, we came into this pandemic in a recession already. We've obviously got some significant challenges. We can't go and sort of throw 150 billion pounds at our economy. We can't do $1 trillion or $2 trillion stimulus. We just don't have that level of capital. So our economy has been struggling for a while, and the pandemic has just made it harder. But there are some benefits to it. So the one is obviously commodity prices at much higher levels. And that's not just the preciouses, the PGM baskets and gold. It's also the industrial metals, zinc, iron ore. And we, when we think about our mining sector as investors, we typically focus on the precious metals, and because they're the listed space, but actually we've got a lot of other sort of industrial metals that we are mining as a country, and those prices are all sitting a bit better. So the higher price simply helps us because that people are paying more dollars per ounce, per kilogram, per ton, depending how it's priced, and those dollars are flowing in to be converted. As I said, the emerging market risk on sort of trade. So certainly we have seen some good strength in the Rand. I think a move down to about 15, probably not in a hurry, but between now and sort of the end of the year is probably on the cards. 15, maybe a 14.50, but I don't think we're going to get back to that sort of 11 and change which we saw when President Ramaphosa was sworn as president of our country back in February of 2018, which we can see as the low point on the chart. But certainly, and Wayne McCurry always says it best. He says, the Rand's got a fair value of about 15.50. He says, but you would never know it because it trades all over the place. It can go easily a Rand or 2 or even 3 either side of that fair value. But if I quickly just go to my watch list of emerging market currencies, we're not even the strongest. I mean, the zloty, the Korean won, the Turkish lira, it's a general EM risk on, but a lot of the others are actually doing better than we are as an EM currency.
Yeah, and I suppose, Simon, looking at this basket of emerging market currencies and sort of riding on the strength of Biden, or the question certainly that I have is, how much longer can we rely on, the Biden push? And
Yeah.
you pointed it out, we entered the pandemic, we're already in a recession. So economically, I think the fundamentals aren't necessarily in place to support the strength of the rand. So how far are we really, or how far is this wave we're riding on going to take us before, the cracks start showing? And once again, it's a waiting game, but I don't think it's going to be very long before we start seeing those cracks.
Yeah, I think you're right. And I mean, if we ponder, what sort of policies could Biden put in place in his first 100 days? And those first 100 days only start in 20 January, so they're more than 2 months away still. What sort of policies could he put in place quickly that would really benefit EMs? And there's some, the tariffs on aluminium and steel, that would certainly help in a quick hurry. But there's not a giant amount that he can do. So this is very much a case of investors saying, look, the tech in the US and the Nasdaq and the S&P has been going sideways for a couple of months now, and they're searching for that yield. They're searching for the return. SA Inc. had a really good run last week on the JSE, but it can turn just as quickly. And I think the bigger driver, or the more consistent driver here, is going to be those higher commodity prices. If they remain elevated, that will give some help to our currency. But the investors who rushed in last week, they will rush out on a dime, as soon as Nasdaq looks like it's making new highs or the like. So I think you're 100% spot on. I calling the rand is it's not even hard. It's impossible. Every month I do a small purchase via the Center Bank Shift app. I buy myself some dollars. I got 1604 last week, and I thought I was the cleverest oak in town. And now we're staring at 1554, which kind of sums up the rand for you. You think you got a good price, and then like days later, it's 50 cents better.
Yep. And I think, again, speaks to that volatility where the moment you think it's great, it's probably either going to get better. And the moment you think it's worse, it gets even worse.
Yeah.
So, very much all over the place, unpredictable, and going to be quite difficult to call, I think. But maybe not as much because, like you pointed out, a little more certainty and hopefully no more governing via Twitter
Yes.
from the US.
Yeah.
So looking for a bit more stability there. Moving on to results and, Dis-Chem coming in and quite a nice set of results, I think, under the circumstances, but perhaps not particularly surprising, given the fact that, a lot of things were flying off the shelves when we were hoarding, Lord knows whatever we were hoarding, toilet paper and sanitizer and probably just buying, a lot of little remedies just to keep ourselves safe during the pandemic. But a nice set of results coming out of Dis-Chem, but also they're talking about a few more acquisitions from for the group. So that should be a quite interesting development.
So for me, Danae, I mean, to your point, the numbers weren't bad. They, as you say, obviously, they were operating even during hard lockdown, although remember those days where certain parts of the stores were taped off and the like, but they made that up on masks and sanitizers and all the other bits and pieces. So not a bad set of numbers from them. What really struck me, so they scrapped the dividend, and they certainly had the cash, but they did it because of two acquisitions, and they're looking at two. One is a community-based pharmacy, and the other is a medical sort of medical insurance type of product. And both of those really store as distinct from Clicks. And that to a degree has, there's many distinctions between the two, but that certainly has been one of those distinctions between them was the big box nature of Dis-Chem. But what they have rolled out is their telemedicine. And I haven't used it, but I know people who have, and they absolutely rave about it. So basically, you go into a Dis-Chem, there's a nurse nurse there who can check your vitals and take your heart rate and blood and stuff. And then you connect to a doctor via Zoom or whatever it might be. Go to webinar or something, and the doctor can then do the consult and then issue a script, which you then obviously fill within the Dis-Chem. Now, that doesn't work for everything, but it works for a lot of GP visits. If you've got a tummy bug or something like that, and the key point is their pricing points. They're pricing it at and I've had different views on what the price is. Some people have said it's around $250, some said $350, but call it around that $350 level. That's about half to what an average GP in a city, Durban, Cape Town, Johannesburg is charging. They're not targeting people who would typically go to a government clinic. That's not their market. They're trying to catch that sort of mid-tier, mid-LSM. And if you then bring community pharmacy into that, if you bring some sort of medical aid / medical insurance into that, suddenly you can see a whole different game from Dis-Chem, which I think can be significantly powerful for them in the years ahead. It's not going to happen overnight, but they've been rolling it out, and it is something which I think, when we chat in a year or two, they could have this entire little sort of telemedicine sort of division, which is suddenly doing significantly well. And I think kudos to them. The pharmacy. Everyone's rushed into that. ShopRite, Clicks, everyone's now got the pharmacies. And Dis-Chem's come along and said, fine, but we can actually do this a little more cleverer even. And I think it's a great initiative coming out of them. We need to see the details. Obviously, they haven't announced who or anything the case of, but I'm keen to see where it comes.
Yeah, and I think, Simon, in terms of their new operating model and sort of, providing that level of insurance or cover, whatever you want to call it, it'll be interesting to see. And certainly anyone who has medical aid will understand the frustration of, say, running out of medical aid savings halfway through the year.
Yeah.
And I think there's a big market in terms of having almost like a medical savings gap cover, if you will, that will just help tide you over for those times that you'll need to run into the pharmacy and get medication, but you can't because you've run out of savings. So I think there is certainly a lot to look forward to in terms of how the model actually works in real life and how they roll it out and how many people actually take it up.
Yeah.
So I'm quite keen to see how that's going to pan out.
Yeah, I think it's exciting. It's going to be fun to see. And it might not work as great as we're thinking, but I think it's a great initiative, particularly because medical is just such an expensive, even if it's just a tummy bug or something, your medical is expensive. Your medical aid always runs out so early in the year. And I think there's a significant market potentially for them in this space.
Yep, definitely. And now turning to Richemont, who have, and we touched on Jack Ma earlier, they've got a partnership that they're working on with Alibaba. And I think that was sort of like something quite that stood out in their results. And quite interesting because I think, the Chinese market has been very key for them. You've got an upcoming middle class, you've got young professionals who are always looking to be snazzy. And I think Richemont can really feels that they can plug in that gap. But obviously with the pandemic, there were just some concerns around demand. But I think this partnership might possibly help them recover despite, the sales shortfall due to the pandemic.
Yeah, I got to say, the Richemont result surprised me, and if we look at that chart for last week, it surprised everybody. I wasn't alone. What surprised me about it is, obviously, that they're sitting on boatloads of cash, billions of euros. That's not unusual for them. They always have a very sort of healthy, conservative balance sheet. That's just how Richemont has always been run. What surprised me was their move into online being just so successful. They bought the watch business in the UK a couple of years ago. They've had the Pret-a-Porter, and it was doing okay. And online was certainly sort of picking up more recently, as you mentioned, the tie-up with Alibaba. But I didn't think that someone who was going to go and buy a very expensive Cartier watch or handbag or whatever would go online. I really thought a good part of that process was the experience, was the going in store. And I'm 100% wrong. I mean, it is absolutely working. Now, in part, of course, we've been driven to it via pandemic, but I thought people would, you're not going out, so no one is seeing your Cartier wristwatch or something. So I thought people would then sort of wait and say, well, let's wait until I can go. Let's wait for physical stores to open. But they didn't. I mean, they were absolutely out there shopping. A really good set of numbers from Richemont. The share is pretty much trading at levels which it was 5 years ago. Again, volatile within that. It keeps on dipping down to around the 85, 90 rand level, but sort of back at the top of that range. It is not cheap. Richemont is never cheap. It is not a great dividend payer. It's never a great dividend payer, but it is an incredibly well-run business, and they proved it again with what I think were, all things considering, luxury in a pandemic is not something that you would have expected to do so well, and they absolutely haven't. And kudos to the management team, and kudos to the investors, particularly those who again had that opportunity back in late March where it was trading at around 80 rand. The play on Richemont seems quite easy. Sub 100, you pick some up, and then at around the 125, 130, you can lighten on it. But top management. And the last point on it is there's also potentially some activity for maybe some corporate action. Remember the LVMH and Tiffany, which is now falling apart. But we're looking at some potential consolidation in the top-end luxury market. Richemont, when asked, sort of were a bit coy, but their answer was, you know what, at the right price, anything is for sale. So there might be either Richemont as suitor or perhaps Richemont as someone comes pouncing for them. Time will tell.
Yeah, definitely. And I think, Simon, to your point, and I think, had spoken about this a couple of episodes prior around, and we were talking about Adidas and Nike sales online. And, the whole thing was, you're not buying things because you're not going anywhere. And with luxury sales, it's all about the experience. So this certainly is very surprising because you'd expect, rich people to be buying things so that they can be seen, but clearly not.
But it's also 100%. It's also a case of, it goes back to my personal experience. I mean, I've been using online since 2000. Banking, air tickets, holidays. It was easy. It's a pair of docs. I know my size. I know what I want. So everything's easy. And maybe if you're rich, you just want a Cartier in a different color, perhaps. So we have seen a massive move to online across different industries globally. And I suppose in some senses we shouldn't be so surprised that it also happened in the luxury end of the market.
Definitely. And now the last on our results updates would be is Foschini. And obviously all eyes are on the jet story and what they plan on doing with that. But obviously also those results were a lot better than I think we expected. And that was largely due to, the fact that, as with all things, it's the impact of the pandemic, but also, those restrictions around what people can and can't buy, even with shops that are considered essential services. So you can buy clothes, but you can't buy these kinds of clothes, and you can't buy these kinds of clothes. So I think very surprising under the circumstances, but interesting to see that they also gave an update about their online business, which was also quite, I think South African retailers, some have been struggling really, especially in the clothing business, to get that right. And it'll be interesting to see how much they've learned and how much they're willing to invest going forward.
I think you're spot on. And I think the results were certainly for my mind, a little bit better than expected. And in particular, of course, it was lockdown and the like. UK for them is still a horror show. We get that. I think the market is basically pricing the UK at a zero. The Jet, I think they got Jet at a really, really good price. They've taken their debt from about some 8 billion to around 2 billion with the rights issue they did. And what we've seen in our market, particularly with the small caps, Adapt IT, AdCorp, and a bunch of others, where the market has fundamentally mispriced, and then an update comes and suddenly the stock, in the cases of Adapt and AdCorp, literally doubles in a matter of hours. And I think that as investors, we should be having some hard looks at some of our other businesses, and some of them. Leisure in particular, it's going to stay tough out there. Others are banks, we've spoken before, the valuations are there, but what's going to push them higher and the like. But I look at something like Foschini, and I think to myself, man, I can't, at call it 92 Rand, I mean, surely this is a better stock than that. Now, not in the immediate, but again, let's roll forward a year or two when the pandemic's behind us in South Africa, when things are looking better. Let's say that the UK is a complete disaster, but let's say they start to do a little bit better in the online. Let's say that the Jet works reasonably well, but doesn't knock it out the park. There are some SA Inc. companies out there which I think are offering opportunity, and Foschini Group has long been sort of, along with Mr. Price, sort of the better fashion managers in the retail space in the listed South African environment. I'm not saying that listeners should rush out and be buying Foschini, but what I'm saying is go do some digging, go have a look at some of these balance sheets and find the stronger balance sheets, and understand that of course margins came under pressure, but surely they can at some point in the next year or so get those margins back to pre-levels. How is their debt? In the case of Foschini, massive pay down of debt puts them in a significantly stronger position. And it's not just Foschini. I think there are a bunch out there where there is potentially some digging worth being had, and then some investment opportunity available.
Yep, definitely. And I quite like the point around shopping around and, sort of comparing balance sheets across the retailers, because I think there are multiple stories currently going around, and in order to be prudent, you really need to do your homework, and actually, instead of going with what you think is true, actually doing the digging, because I think what the results or the comparison will show you is so much different from what you think is being said. Certainly on a lot of popular people tweets and etc.
Yeah.
So always valuable to do your own work.
And simple stuff. We don't have to become CAs. It's things like look at debt to equity, stuff. Look at operating margins, and how they compare across their different peers and the like. And you start doing that, and it's the same with banks and the like. None of this is necessarily rocket science, and it quite quickly you start to see sort of almost two tiers, a sort of an A tier and the rest. And make no bones, if we have a good economy next year and we do the 3.5% Mbowene's hoping we do and the like, rising tide lifts all boats. But let's rather be in the luxury cruise liner rather than the sort of leaky little dinghy type of scenario.
Nope, definitely. And then lastly, to close off today, and very big news for us, certainly, Aspen agreeing to a joint venture operation with Johnson & Johnson around a COVID vaccine and manufacturing it. And that obviously was great news and helped the share price quite a bit. But I think very exciting the fact that, there's also a South African company sort of helping to spearhead or coming out quite ahead in the race to get a COVID vaccine out there.
So there's a couple of points. Just from the basic, the public health. If they make 300 million vaccines in a year, they're going to have to leave, and I say they, I mean Johnson & Johnson and Aspen, are going to have to leave 60 million in South Africa for our population to be vaccinated. There is, if you want to ruin a reputation and have people banging down your door, is ship all 300 out of the country. So which means that in the queue of getting vaccines, and this was an interview I referenced, I think way back sort of mid-year, it was in Wired magazine with Bill Gates, and he said, look, it's really going to be a two-tier process. The developed sort of markets will get the vaccine during the course of 2021, and the lesser developed sort of emerging markets will get it during 2022, and we would fall into the latter category. But if we're producing locally, then it means South Africans will get vaccinated ahead of where we would otherwise normally have been in that queue. For Aspen, there are a couple of really big things. Firstly, they're not going to make money off this. There's no chance that there's going to be fat profits on a vaccine for a pandemic. That's just, again, if you want to get on the wrong side of the story. So it's going to be quite small margins. But it tells us two things. Firstly, Johnson & Johnson chose Aspen. They've had lots of conversations with lots of different manufacturers, and it shows us that that factory in the Eastern Cape that Aspen has is world class. What it also does, quite interestingly, is whilst Aspen's not going to make a lot of money from it, they're going to get utilization through the factory, because this, at 300 million a year, that's 25 million a month. That's not 100% of their capacity. So what it's doing is it's just creating utilization, which means that factory isn't sitting idle, or it's sitting less idle, as the case may be. So it certainly benefits them. It might not be a direct profit scenario for Aspen, but it's utilization, which is always hugely important. And then we look at Aspen, and we on the chart here, you go back to 2016 when it traded at 400, and that was a ridiculously priced stock. We look at this price collapse back in September of 2018. But the Aspen of today is very different. They have massively paid down their debt. They've got rid of a number of different operations. Their milk formula in Asia, out of New Zealand, they're getting rid of their thrombosis, although they'll still have rights in Europe. So their debt has gone from over 50 billion. I calculated at this point it's probably around 20 billion. So they're well within their covenants again. And this is a incredibly well-run company with a great management team in healthcare, which even outside of a pandemic is certainly a sector worth having a look at. And I think Aspen, we have on the JSE, and I know that we shake our head and say there's nothing to buy. We have excellent companies on the JSE, not all of them, but we certainly have enough for the average investor. Some of them, and some of them, what a pandemic does for you is it gives you a really, really good price. And I think, again, and let's be quite clear, at 140 Rand on a PE of around 10, I thought Aspen was a really good price. Now it's 122 Rand, so, color me wrong on that one. But on a long-term view, Aspen is a very different company to what it was just 2 years ago, and I think a fundamentally better company for it. And I think the Johnson & Johnson deal kind of like helps confirm that. Now, of course, Johnson & Johnson might not get the vaccine. There's all of those trials still happening, but it is certainly a vote of confidence from a global drug manufacturer.
Yeah, definitely. And I think, to your point, Simon, the margins might not be that great, and there probably won't be any profit involved. But I think, over and above the utilization, it's nice, or it'll be great for them. It's great PR, so to say, for them. And I think that hopefully will open some doors for them and put them on a good holding. Yeah. I see you're having a look in response to William's question around Brimstone.
So William,
chat quickly.
Brimstone, not a it's actually a good company, and they have some really good assets. Some of their assets have really, really struggled under the pandemic. No surprises around that. However, it's a company which the market has just hated. And the one point is, you can't fight the market. And what we're seeing with Brimstone, but with others like it, which are essentially holding companies, those discounts to net asset value have just widened. And it's everyone. It's Naspers Process. It's Remgro. It's PSG. We see it's Zeda. Across the board, markets, and I don't know why, are taking a jaundiced view of holding structures on our JSE. And whereas those discounts used to be 15 or 20%, now they're sitting out there at 30 or 40%. And I've been scratching my head about it, and it makes no sense whatsoever. Brimstone's one of those. The other one is Sabvest as well. It boggles my brain. They've got some great assets there. They've got some less great assets as well. But the market has just been saying forever and a day, thanks, but no thanks. And, the market might be wrong, but trying to fight it can be a painful attempt.
Yeah, thank you, Simon. And I think we've reached the end of our session today. So thank you to everyone for joining us. And we look forward to chatting again next week. And Simon, thank you very much. As always, very insightful, and look forward to chatting a lot more about what's happening all around the world.
Cool. Thanks
everyone.
It's great to get our Monday chats back. We'll chat again, everyone, next week, everyone. Cheers all.